Sneha Sharma, and this is my project for Finance 452. My project is on investment strategy. Now, for our class, we had to pick one investment strategy that we thought was good for investment. So my strategy is higher the EVA momentum, better the investment. EVA stands for economic value added. In order to test my hypothesis, I picked 15 companies with high EVA momentum over 5 years of time. And I picked 15 companies with a random EVA momentum over 5 years of time. My first 15 companies with a higher EVA over the 5 years of time, was Priceline.com, Gilead Sciences, Intuitive Surgical, Intercontinental Exchange, Diamond Offshore Drilling, GDS, Uniface, Celgene, Google, Discovery Communications, Apple, Southwest Energy, Cognition Technological Solution, MasterCard, Red Hat, and Biogen IDEC. My 15 companies with a random EVA momentum was Hudson City Bancorp, Altera, CVS, Wind Resorts Limited, Akamai Technology, El Paso, Devon Energy, Citigroup, KeyCorp, Linear Technology, Bank of New York Mellon, Legmenon, Noble Energy, SLM, and Verisign. Now, the first step we did was some computations to analyze the performance of these companies. What we did was we got the average return for each company in both portfolios for each year. Now, we computed their variance and standard deviations. Standard deviation here determines the risk. The overall risk and return for the portfolio was calculated over the 5 years of period. S&P 500 was our benchmark to evaluate the performance of the company. Now, our results. Several tests were performed, and graphs and equations were evaluated for each of the portfolio and the market over the period of 5 years of time. Again, our market is taken as S&P 500. Now, we can see the graph for higher EVA and market. We can see there's a positive relationship between the high EVA momentum companies and S&P 500. And this is our equation, which states that they have a positive slope. And if market goes up, the companies goes up too. The return for the company goes up too. This is the graph for lower EVA and a market. We see that they have a positive relationship to the market as well. So if the market goes up, the companies go up too. But if we go back and compare the slope of higher EVA market and lower EVA market, we can see that higher EVA market is more correlated with the market. Now, what does the graph tell us? Higher EVA market tells us that graph is increasing. Company has a positive relationship to the market and the slope is 0.964. And lower EVA and market tells us that the graph is increasing, positively related to the market, but the slope is less, which is 0.1556. Now, the comparison between two different portfolios, one with a higher and one with a lower EVA momentum. According to our evaluation, we can see that the return on the higher EVA portfolio is 25.39% over the 5 years, and their risk is 8.22%. And the return on the lower EVA momentum portfolio is 15.38% over the 5 years of time, with a risk 15.89. Now, t-test for two portfolios. The t-test shows that the result is positive. So we don't reject our null hypothesis, which is better the EVA momentum, better is the investment. This is our result for the t-test. In conclusion, we saw that the return of a higher EVA stock were higher than the return to the lower EVA stock for given or lower level of risk, as we saw in the evaluation earlier. Our return for the higher EVA was 25 and risk was 8, whereas the return for the lower EVA was 15 and the risk was 12. So it clearly states that higher the EVA momentum, the better is the investment. Similarly, t-test result showed that our null hypothesis is true. That means the higher is the EVA momentum, the better is the investment in a company. Now, let's talk about the limitations in finding our results or evaluations. The first limitation of the project was the number of observations. When we're making a statistical references, the more the observation, the better the result is. So if we could take more data than just 30 companies, we would have more accurate data. And it is very difficult to predict the result based on a few observations and a limited time interval. If we can pull out more data or evaluate the companies based on a long period of time, we would get more efficient or accurate data than what we have. So the more data we take, more accurate result we can obtain. This was my this was my project on investment strategy. I hope you like it. Thank you for watching.